In 2021, a 29-year-old was running a $32 billion financial empire from a penthouse in the Bahamas. During video pitches with powerful venture capital firms, he didn't even pretend to pay attention. He was openly playing League of Legends. The cryptocurrency market was exploding, and Silicon Valley investors were terrified of missing the boat. They stopped analyzing business models and started chasing anything with momentum. Sam Bankman-Fried intentionally leaned into this chaos. He slept on a beanbag under his desk and showed up to high-stakes meetings in cargo shorts and a wrinkled t-shirt. He projected the specific image of the eccentric genius that the tech world has been conditioned to trust. When Sequoia Capital watched him play a video game while answering their questions about risk management, they didn't walk away. They wrote him a check for $200 million. For many investors, his unprofessionalism was treated as a signal of superior intelligence rather than a warning sign. Founders often use manufactured quirks to bypass logical scrutiny. Elizabeth Holmes built a $9 billion medical company without a working product by wearing a black turtleneck and using a faked dramatic voice to project a sense of intellectual authority. This follows the pattern of the late 1990s dot-com bubble, where Wall Street threw hundreds of millions of dollars at companies like Pets.com because they had a catchy domain name and a sock puppet mascot. This structure created a massive conflict of interest. Bankman-Fried ran FTX, a supposedly safe exchange for consumers, while simultaneously owning Alameda Research, a hedge fund making incredibly risky, speculative bets. This setup mirrors the Enron collapse, where executives used confusing special-purpose entities to hide massive losses, essentially selling the company's garbage assets back to themselves to manufacture a profit. Managing both risk-free consumer deposits and high-risk gambling bets under one roof is a catastrophic structural flaw. To fund Alameda's bets, Bankman-Fried's exchange simply invented its own cryptocurrency token, called FTT, out of thin air. FTX hoarded the majority of the supply for themselves, artificially pumping up the price and creating a multi-billion-dollar valuation on paper. Alameda then took these fabricated tokens to the broader financial market, using them as collateral to borrow billions of dollars in real cash. This fragility mirrors the 2008 financial crisis, where Wall Street bundled toxic subprime mortgages into shiny, safe-looking packages and passed them off as investments until the entire system blew up. FTX was a financial Jenga tower held together by made-up collateral and wild market optimism. In November 2022, a leaked balance sheet revealed that Alameda's genius trading assets were almost entirely comprised of Bankman-Fried's own FTT tokens. The revelation shattered the illusion of stability, triggering an immediate wave of market panic. Thousands of customers rushed to the FTX platform to withdraw their funds, creating a digital version of the bank run seen during the Great Depression. When customers went to withdraw their cash, the vault was empty. Bankman-Fried had secretly taken billions of dollars from customer deposits and loaned it to Alameda to cover their massive gambling losses. $32 billion of market value evaporated in a few days, popping the 2020s crypto bubble. While his company was collapsing, Bankman-Fried was still being marketed as a champion of a philosophy called effective altruism. He claimed he was only getting rich so he could give all his money away to save humanity. This echoes the later years of John D. Rockefeller, who hired PR experts to soften his image as a ruthless monopolist by funding charitable foundations and handing out dimes to children. In reality, he used stolen customer funds to buy political influence, secure celebrity endorsements, and high-end Bahamian real estate. Dressing extreme greed up as philanthropy creates a psychological shield that makes it difficult for regulators and investors to question a founder's motives. The collapse of FTX exposed a deeper structural vulnerability in modern high-stakes investing. If a founder builds a complex, impenetrable black box and loudly proclaims their charitable intentions, many investors will stop asking questions and simply write a blank check. If the person holding your life savings is prioritizing a video game over a financial audit, it is time to find a new bank.